Hello and welcome to Bony's Life, the show where we take the most complex financial market in human history and make it make sense. I'm your host, Boni, and if you're new here, let me tell you something. You've just stumbled onto the most important 30 minutes of your trading week. We are going to cover everything: technical analysis, fundamental analysis, global macro events, expert commentary, and a complete trading game plan for the week of February 23rd through the 28th, 2026. Whether you're a seasoned trader who eats candlestick charts for breakfast, or you're someone who just learned what a wallet is last Tuesday, this episode is built for you. So let's not waste a single second. Let's get into it. Before we dive into the deep end, let's set the stage with where the market stands right now. According to live data from CoinGecko, the total global cryptocurrency market capitalization is sitting at approximately $2.405 trillion, with a 24-hour trading volume of $55.832 billion. Bitcoin's market dominance is at 56.5%, which tells us that Bitcoin is still the undisputed king and that altcoins are struggling to keep up. Bitcoin itself is trading at around $67,981 with a modest 24-hour gain of 0.2%, but it's down 3.4% over the past 7 days. Ethereum is at $1,975, up 0.7% in 24 hours, but down a more painful 5.3% on the week. XRP is at $1.42, down 10% on the week. Solana is at $85.27, down 5.9% on the week. And Dogecoin, yes, the meme that became a market, is at $0.097, down a whopping 16.1% over 7 days. The market is clearly in a period of consolidation and stress, and understanding why is the key to knowing what comes next. Now let's get into the meat of segment 1, the technical analysis of the past week. The story of the past 7 days is really a story of two forces: a market trying desperately to find a bottom, and a market that hasn't quite convinced itself it's found one yet. Bitcoin has been trading in a very tight range, between $66,456 on the low end, recorded on February 19th, and $67,489 on the high end, recorded on February 18th. That's a range of barely over $1,000 on a nearly $68,000 asset. What does that tell us? It tells us the market is in a standoff. Bulls and bears are both watching, both waiting, and neither side is willing to commit fully. This kind of tight consolidation after a significant downtrend is actually a classic technical pattern. It can resolve either way, but the longer it holds, the more explosive the eventual breakout tends to be. And trust me, when Bitcoin moves, it moves fast. Now let's look at the derivatives data, because this is where the real story lives. According to CoinGlass, in just the past 24 hours, a total of $161.87 million in positions were liquidated across all major exchanges, affecting over 77,000 traders. That's a lot of people having a very bad day. But here's the fascinating part. Of the $83.64 million in liquidations tracked in the most recent session, approximately $65 million were short positions. Short liquidations dominating long liquidations is a classically bullish signal. It means that people who were betting on the price going down got squeezed out of their positions, which forces them to buy back, which pushes the price up. This is what traders call a short squeeze, and the conditions for one are building. The market is like a coiled spring right now, and the question is, which direction does it uncoil? Here's where it gets truly fascinating from a technical standpoint. According to groundbreaking analysis published by Matthew Sagal, head of digital assets research at Van Eck, Bitcoin is currently trading at negative 2.88 standard deviations below its 200-day moving average. To put that in plain English, this is a level of statistical extremity that has not been observed in the past 10 years of Bitcoin's history, or not during the COVID crash of March 2020, not during the catastrophic FTX collapse of November 2022. The 200-day moving average is the gold standard of long-term trend analysis, and being nearly 3 standard deviations below it is like being in the financial equivalent of the Mariana Trench. Historically, when assets reach this level of deviation, mean reversion, a return toward the average, becomes statistically probable. Furthermore, the RSI on Bitcoin futures charts has dipped below 21, which is deep into oversold territory. And as of February 21st, analysts at Brave NeoCon identified a bullish MACD divergence forming at the $68,000 level, a pattern where price makes lower lows, but the MACD indicator makes higher lows, signaling weakening bearish momentum. These three indicators together paint a compelling picture of a market approaching a potential turning point. But technical analysis is only half the story. Let's talk fundamentals. The macro environment has been a significant headwind for crypto in 2026. Bitcoin is down approximately 24% year to date, and Ethereum is down a brutal 34%, and the worst starts to a year in the history of both assets. The Federal Reserve held interest rates steady at 3.5% to 3.75% at its January 27th to 28th meeting, and the FOMC minutes released on February 18th confirmed that policymakers see no urgency to cut rates in the near term. Higher rates for longer means less liquidity in the system, which historically pressures risk assets like crypto. However, there is a silver lining. January's consumer price index came in at 2.4% year over year, below the expected 2.5%, suggesting that inflation is continuing to cool. As Forbes noted just yesterday, real-time data and structural lags in shelter costs suggest headline inflation has further to fall. If inflation continues to decline, the Fed may be forced to cut rates sooner than the market expects, which would be a major catalyst for a crypto recovery. Now let's talk about the institutional picture, because this is where the big money moves. Bitcoin spot ETFs have experienced 5 consecutive weeks of net outflows, totaling approximately $3.8 billion in withdrawals. On February 18th alone, Bitcoin ETFs saw $133.3 million in daily net outflows, led by BlackRock's IBIT, which shed $84.2 million, and Fidelity's FBTC also recording significant outflows. Bitcoin futures open interest has collapsed by more than 20% from its peak, indicating that leveraged long positions have been dramatically reduced. This deleveraging, while painful in the short term, is actually a healthy process. It clears the market of weak hands and over-leveraged positions, creating a more stable foundation for the next move up. As VanEck's Matthew Siegel put it, this sell-off reflects orderly deleveraging rather than capitulation. The distinction matters enormously. Capitulation is panic selling. Deleveraging is strategic reduction. One signals a bottom, the other is the process of finding one. All right, let's shift gears and look at what's coming this week, because the calendar is absolutely stacked. In the crypto world, we kick off with NeoCon 2026 in San Francisco on February 23rd and 24th. This is the flagship conference for the Neo protocol, one of the most promising Layer 1 blockchains in the space. Expect announcements around ecosystem development, developer tooling, and potentially new partnerships. On February 27th, we have XRP Australia 2026, a major conference bringing together DeFi leaders, innovators, and decision-makers to shape the future of decentralized finance in the Asia-Pacific region. Flare Networks is a key participant, which adds an interesting cross-chain dimension to the discussion. And then, the event that every serious crypto trader has circled on their calendar, the monthly Bitcoin and Ethereum options expiry on Friday, February 28th. This is the last Friday of the month, which means Deribit, the world's largest crypto options exchange, will settle a massive volume of contracts. The max pain price, the level at which the maximum number of options expire worthless, will be a gravitational force on price action throughout the week. Watch it closely. Now, let's look at the traditional financial markets, because in today's interconnected world, what happens on Wall Street absolutely reverberates through the crypto markets. The week begins on Monday, February 23rd, with a speech from Federal Reserve Governor Christopher Waller, one of the more hawkish voices on the Fed board. His comments on inflation and the rate outlook will set the tone for the week. Tuesday, February 24th, is the busiest day of the week, with speeches from Fed Presidents Goolsbee, Bostic, and Collins, plus the CB Consumer Confidence Report, which is expected to come in at 85, slightly below the previous reading of 84.5. Consumer confidence is a leading indicator of economic health, and a weaker than expected reading could signal economic slowdown, which paradoxically could be bullish for crypto if it accelerates rate cut expectations. On Thursday, February 26th, we get the initial jobless claims data, forecast at 210,000. And on Friday, February 27th, the week culminates with the Producer Price Index PPI data, with the monthly reading forecast at plus 0.3%. PPI is a leading indicator of consumer inflation, so any surprise to the upside could rattle markets significantly. The regulatory environment is also shifting in ways that will have long-term implications for the entire crypto industry. The SEC and CFTC are jointly advancing Project Crypto, a landmark initiative announced on January 29, 2026, by SEC Chair Paul Atkins and CFTC Chair Michael Selig. This is a unified regulatory framework designed to bring clarity and consistency to the digital asset space, something the industry has been crying out for since its inception. The significance of this cannot be overstated. Clear regulation is the single biggest unlock for institutional capital. When the rules of the game are clear, the big players, pension funds, sovereign wealth funds, insurance companies can enter the market with confidence. We're also keeping a close eye on the Trump administration's strategic Bitcoin reserve, established by executive order in March 2025. This reserve, funded by forfeited Bitcoin held by the US Treasury, represents a fundamental shift in how the world's largest economy views digital assets. Any updates on the reserve's size, management, or expansion would be a significant market catalyst. And finally, CME Group, the world's largest derivatives exchange, has announced it will launch 24/7 cryptocurrency futures and options trading starting May 29, 2026. This is a game changer for market liquidity and will fundamentally reshape how institutional traders interact with the crypto market. Let's hear from the experts, because the smartest people in finance have very strong opinions about where this market is headed. On the bullish side, Cathie Wood of ARK Invest has staked her reputation on a $28 trillion crypto future, arguing that digital assets are in the early stages of a multi-decade adoption curve. Her firm's research suggests that Bitcoin alone could reach prices that would make today's levels look like a rounding error. Michael Saylor of MicroStrategy, who has accumulated over $75 billion in Bitcoin for his company's treasury, continues to be one of the most vocal advocates for Bitcoin as the ultimate store of value. He recently predicted that Bitcoin will outperform the S&P 500 over any meaningful time horizon, and the prediction markets are giving us interesting signals too. As of this week, there's a 51% probability that Bitcoin hits $75,000 before the end of February, according to crowdsourced prediction market data. But intellectual honesty demands we also hear the bearish case. Standard Chartered, one of the world's most respected financial institutions, has dramatically revised its Bitcoin year-end target from $150,000 down to $100,000 and has issued a warning that Bitcoin could dip to $50,000 before staging a meaningful recovery. The analysts cite ongoing macro headwinds, continued ETF outflows, and weak retail participation as key risk factors. Bloomberg Intelligence's Mike McGlone has gone even further, suggesting that if global liquidity continues to tighten, Bitcoin could theoretically gravitate back toward $10,000. Though he acknowledges that the structural support from ETF buying and corporate treasury adoption makes this an extreme tail risk. The more balanced view comes from VanEck's Matthew Siegel, who notes that the current drawdown, with Bitcoin down approximately 47.5% from its peak, is severe but not unprecedented, and that the combination of low realized volatility and extreme statistical deviation from trend suggests the market is in the late stages of stress rather than the early stages of a new bear market. His key insight, absent a new Bitcoin-specific negative catalyst, relative value dynamics may begin to assert themselves. Translation: the market may be running out of reasons to go lower. Now, the moment you've been waiting for, the trading game plan for the week ahead. Let me be crystal clear. Nothing I say here is financial advice. These are analytical frameworks based on publicly available data. Always do your own research, manage your risk, and never invest more than you can afford to lose. With that said, let's talk strategy. For the range-bound trader, the current market setup is actually quite attractive. The key support zone to watch is between $66,000 and $66,500. This level has held multiple times over the past 2 weeks and represents a significant area of demand. A confirmed bounce from this support, ideally on declining volume as the price approaches it and then increasing volume as it bounces, would be a classic long entry signal. The initial target would be the resistance zone between $68,288 and $70,000. A decisive break and close above $70,000 on the daily chart would be a major bullish signal and could trigger a rapid move towards $75,000. And beyond, conversely, a break below $66,000 on strong volume would be a warning sign that the bears are regaining control, and the next significant support would be around $60,000 to $62,000. For the long-term investor who isn't interested in short-term trading, the current environment presents a compelling dollar-cost averaging opportunity. With Bitcoin trading at nearly 3 standard deviations below its 200-day moving average, a level of statistical extremity that has historically preceded significant recoveries, systematically accumulating Bitcoin at these levels is a strategy with strong historical precedent. This doesn't mean the price can't go lower. It absolutely can. But it does mean that the risk-reward ratio for long-term accumulation is more favorable now than it has been at any point in the past decade. For the options trader, the February 28th monthly expiry is the key event of the week. The max pain price, the level at which the maximum number of options contracts expire worthless, will act as a gravitational force on price action. As the expiry approaches, market makers will hedge their positions in ways that tend to push the spot price toward max pain. Monitoring the max pain level on platforms like Deribit and CoinGlass throughout the week will give you a significant informational edge. Additionally, with implied volatility currently elevated, selling options premium through strategies like covered calls or cash-secured puts could be a way to generate income in this uncertain environment. Beyond Bitcoin, there are some interesting altcoin dynamics to watch this week. Solana has been showing relative strength compared to Ethereum, with its ecosystem continuing to attract developer activity and user engagement despite the broader market downturn. The NeoCon conference this week could be a catalyst for Neo Protocol, which has been building quietly in the background. XRP is worth watching around the XRP Australia conference on the 27th, as positive sentiment from the event could provide a short-term boost. However, the most important thing I can tell you about trading this week is this: risk management is everything. In a market characterized by extreme fear, high volatility, and significant macro uncertainty, the traders who survive and thrive are the ones who manage their downside first and their upside second. Keep your position sizes small relative to your total portfolio. Use stop-loss orders, don't chase pumps, and remember the wise words that every great trader eventually learns the hard way. The market can remain irrational longer than you can remain solvent. Patience, discipline, and a clear plan are your greatest assets this week. And that, my friends, is your complete crypto market analysis for the week of February 23rd through the 28th, 2026. We've covered the technical picture, from the oversold RSI to the bullish MACD divergence, to the extreme statistical deviation from the 200-day moving average. We've covered the fundamentals, from the Fed's rate stance to the ETF flows to the regulatory revolution unfolding in Washington. We've heard from the bulls and the bears, from Standard Chartered to Cathy Wood to Michael Saylor, and we've laid out a clear, actionable trading game plan for the week ahead. The crypto market is at a genuinely fascinating inflection point right now. The fear is real, the uncertainty is real, but so is the opportunity. The greatest investors in history have always made their best returns by being greedy when others are fearful. Whether this week marks the beginning of the next great bull run or just another chapter in the ongoing consolidation, one thing is certain: you are now better prepared than 99% of the market to navigate it. That's what Bony's life is all about. Be sure to subscribe, hit the like button, and share this episode with every trader you know. Until next week, trade smart, stay curious, and remember, in the world of crypto, fortune favors the informed.